Welcome to this explainer. Today we are cracking open a financial mystery that is the whole market whispering. We're going to examine an unusually massive $7 million insider buy that literally just happened inside a tiny microcap community bank called Union Bankshares or UNB. Look, when an insider drops that kind of cash on a company this incredibly small, it's basically the equivalent of a giant flare going off in the night sky. We need to know exactly what they're seeing that the rest of the market just hasn't caught on to yet. Okay, let's dive right into this. Here is our roadmap for today. We'll be hitting the $7 million signal, the Warren Buffett test, Peter Lynch's golden rule, contextualizing insider moves, and then wrapping it up with the final verdict.
Section 1. The $7 million signal.
Now, corporate insiders buy and sell their own company's stock all the time, right? A few $1,000 here, a few thousand there, it's just standard background noise in the market. But the sheer scale of this specific transaction is exactly why we're talking about it today. $7,170,000. Per the SEC filings on March 19, 2026, a major shareholder named Anita G. Zucker went into the open market and bought roughly $7.17 million worth of UNB stock at prices between $22.60 and $23.54 a share. Guys, that is not some token purchase just to show a little faith in the management team. No way. That is a massive, table-pounding debt. And this brilliantly illustrates the real disparity of this trade. You have this massive $7.17 million conviction buy sitting right next to the entire total market capitalization of Union Bankshares, which is a tiny $114 million. I mean, in the banking world, $114 million market cap is microscopic. Dropping over $7 million into a company this small is such an incredibly aggressive move. It shows an unmatched level of conviction, mainly because putting that much capital into a microcap stock isn't something you can just easily or quickly unwind. To really put that into perspective, with this single series of purchases in March, Anita G. Zucker effectively acquired about 6.3% of the entire company. Literally one person, one move, and over 6% of the business is snatched up. So when a single insider decides to swallow up that much of the float, we have to ask ourselves, what exactly is she seeing in the fundamental financials of this little Vermont community bank?
Which brings us to Section 2, the Warren Buffett test.
So Warren Buffett famously said, "We're not interested in buying poorly managed banks at a cheap price." He loves banks, for sure, but he demands they have a simple, understandable business model that sits safely within his circle of competence, and Union Bankshares passes this initial test beautifully. They're a community bank holding company up in Vermont, and their business model is as simple as it gets. They take in local deposits, and they make loans. There are no complex derivatives here, no exotic trading desks. It is just classic, straightforward banking.
Let's walk through the rest of Buffett's checklist. Simple business? Passes. But what about earnings stability? Well, they actually had a bit of a rough patch where earnings dipped over 2023 and 2024. But look at this recovery. Net income grew over 26% in 2025, and it jumped another 20% year over year in Q1 of 2026. Now, the economic moat is a bit narrow. Local relationships offer some customer stickiness, but because of its tiny $114 million size, it obviously can't compete with the massive scale of national banking giants. But down at the bottom there, check out that consistent dividend history. That absolutely passes the Buffett test. Now, what's really interesting here is the valuation. Buffett frequently values banks using the price-to-book ratio. As of our data snapshot, UNB has a stock price of $24.81 and a book value of $17.46 per share. That gives us a very reasonable price-to-book ratio of roughly 1.42x. Throw in that really juicy 5.80% dividend yield, and you can instantly see exactly the kind of solid margin of safety and reliable income stream that classic value investors absolutely love. Moving right along to Section 3, Peter Lynch's golden rule.
Okay, to understand Lynch's framework, we just need a quick refresher on the P/E ratio. That's simply a company's price-to-earnings, or P/E ratio, divided by its earnings growth rate. Peter Lynch believed that for a perfectly fairly valued company, the P/E ratio should exactly equal its growth rate, which would give a P/E ratio of 1.0. Therefore, as we all know, if the P/E is under 1.0, you are looking at a bargain.
So UNB's metrics here are just staggering. Compared to Lynch's fair value rule of 1.0, UNB has a current PE of just 9.59x. If we factor in their trailing 12-month growth of 29.08%, their PEG ratio plummets down to a mere 0.33. And honestly, even if we dial that back and conservatively assume only a 20% growth rate going forward, the PEG is still just 0.48. By Peter Lynch's standards, this stock is flashing bright green as significantly undervalued.
Let's move to Section 4, Contextualizing Insider Moves. The thing is, Zucker wasn't actually alone here. The net insider sentiment across the board is heavily positive. We see the chairman of the board buying over $10,000 worth of shares. We see an independent director and the senior risk officer making small but still very meaningful purchases. And notice those prices. These insiders bought in between $22.44 and $25.28, which perfectly aligns with today's $24.81 share price. These insiders are eating their own cooking right at current market levels. But as thorough investigators, we do have to address a potential red flag that popped up in the SEC filings. Back in December 2025, the CEO, the CFO, and an executive vice president all sold shares. Now, on the surface, seeing executives dump shares looks pretty scary, right? But the crucial point here is understanding context. Are we looking at a coordinated, bearish open market sell-off, or are we just looking at standard corporate housekeeping? Well, when we dig into the filings, that red flag completely vanishes. Actually, scratch that. It wasn't a red flag at all. These transactions were explicitly labeled sales to issuer. CEO Silverman's $10,490 sale and CFO Hale's roughly $16,790 sale were quite simply standard corporate transactions just to cover tax withholdings on equity awards. They weren't dumping shares onto the open market because they lost faith in the business. They were literally just paying their taxes so that insider buying thesis, it remains completely intact and highly bullish.
And that brings us to Section 5, the final verdict.
So, let's balance the sheet on our analysis here. On the pro side, UNB is deeply undervalued based on its earnings growth, boasting that crazy PEG of 0.33. It pays a massive 5.8% dividend yield, easily passing the Buffett value test. And above all, it is backed by an incredibly rare $7 million conviction buy from an insider. But we absolutely have to weigh that against the cons. It is a tiny $114 million microcap stock. That brings higher volatility and serious liquidity risk, meaning it can be tough to buy and sell large amounts of shares quickly. Plus, you obviously have the inherent realities of the banking sector, like shifting interest rates and credit quality concerns. Which leaves us with a final, rather provocative question. Is a $7.17 million conviction buy enough to outweigh the inherent risks of a tiny $114 million microcap bank? Well, Anita Zucker certainly seems to think so, and the numbers present a really fascinating value case. Now, as always, this is an explainer of public data, not financial advice, so please make sure to do your own due diligence. But honestly, when an insider speaks with $7 million, it's definitely a conversation worth listening to. Thank you so much for exploring this financial mystery with me today. Keep learning, keep questioning, and I'll catch you next time.